Welcome back to another video that aims to make you financially savvy. Today we are talking about 5 truths about money that banks don't want you to know. So buckle up and let's go. Banks are the backbone of any economy. Even the Fed is actually a bank, but unlike any other bank, it creates money. But what if I told you that every bank has the right to create money? Theoretically, you can start a bank and start creating money, but there is an easier way. Why waste so much money first starting a bank when you can start a cryptocurrency and become a crypto billionaire overnight? At least that's what has been happening lately. If cryptocurrencies seem to you like a scam, then you probably don't know much about the banks. So, here in this video, we are going to take a look at 5 truths about money that banks don't want you to know, because if everyone would know that, that might be the end of the banking system. Or as Henry Ford said, "It is well enough that people of the nation do not understand our banking and monetary system, for if they did, I believe there would be a revolution before tomorrow morning." So if you are ready, give this video a thumbs up and go ahead and subscribe. And now let's get back to the video. 1. Keeping your money in a bank is a scam. Let me ask you a question. How much interest would you earn if you deposit your savings in a bank? At first glance, it seems like at least a few percent for it to make any sense, right? However, if you look at the numbers, it's far from that. The top banks, such as the Citibank, offer literally less than 0.5%. Some banks offer a higher rate, but they are still more than 1%, especially since interest rates are at the bottom now. Think about it. Your money grows by 0.5%, while inflation is 2.5%. The intrinsic value of your wealth is literally decreasing every single year. You are far better off spending that money today than keeping it in a bank. The purchasing power of your money in a few years is going to be far less than it's now. And when inflation is skyrocketing as it's now, for example, asset prices such as homes and stocks rise exponentially, as we have seen happening in the last year or so. A bank is a place to park your money and not to make money. 2. Every bank has the right to create money out of thin air. If I would tell you that banks do create money, you probably won't believe me, because the only bank that's allowed to create money is the Fed. It's the source of the dollar and the only institution that has the right to that printing machine. However, the system works in such a way that every bank in the country, or, in fact, the world, is allowed to create money to a certain degree based on how much money people have deposited in that bank. Let's say you deposit $1,000 in Bank A. What do you think that bank is going to do with the money? There is no point in keeping it. They wouldn't even be able to pay you your miserable 0.5%. So the bank lends your money to someone else who wants to buy a car, for example, or a house, and collects interest, which is often much higher than 0.5% that it pays you. An average credit card interest is 20%. That's literally dozens of times higher than what the bank pays you. The point is that the bank isn't going to tell you to whom it will lend your money. Whenever you check your account, the bank is going to show you that your money is still there and you can withdraw it whenever you want. So if your money is still there in the bank, where did the bank take the money to lend to someone else? That's known as fractional reserve banking. Banks are allowed to keep just 10% of the deposits and lend the rest. For every $1,000 you deposit in the bank creates another $900 and lends it to someone else, which brings the total amount to $1,900. The bank created $900 out of thin air. It's not as difficult as you might think, since there are just digits in the computer. 3. You can make money by borrowing from banks and investing elsewhere. In July 2012, Mark Zuckerberg financed his $5.95 million Palo Alto home, that's 3 miles away from Facebook's headquarters, with a 30-year mortgage. At that time, he was 28 years old and the world's 40th wealthiest person, worth an estimated $15.6 billion. The question is, why would you get into debt when you have billions of dollars and can easily afford it? If he wanted, he could easily buy a dozen $6 million homes in cash without batting an eye. So why get a mortgage? The answer is, it's free money. Sounds unreal, I understand. Who would give you free money when you are already a billionaire? I mean, why would anyone give anyone else free money unless it's charity? It all has to do with interest rates. Remember when we talked about banks giving such a low ROI that it doesn't worth keeping your money there since it doesn't even beat inflation? So you are losing money? Well, in this scenario, it's the other way around. The inflation rate in the US is 2.5 to 3%, so any money you borrow below the inflation rate is considered free money. Zuckerberg's mortgage rate was just a little over 1.05%. If you do the math, the bank is the loser since the mortgage rate is below the inflation. You don't have to be the genius to do the math. For the sake of example, let's say you borrow $1 million at the rate of 1.05%. The average rate of return on a savings account is 2.4% before the pandemic and now less than 1%, but let's just stick to 2.4%, meaning that even if you deposit that $1 million in another bank, you end up making $24,000 a year. While you only have to make a monthly payment of $10,500, which is 1.05% to the bank that lent you that money. Imagine if you do that with $100 million, or how about $1 billion? When you can borrow for free, there's no point in tying up your own money when you can use that money for more profitable things. Of course, when we are talking about small amounts of money, this might not make sense because the difference isn't that big. However, when it comes to large sums, playing around 1, 2, or 0.5% could potentially mean dozens of thousands of dollars, if not hundreds. 4. The richer you are, the lower the rate you get. Remember that banks are not charity organizations, but are businesses like any other whose job is to maximize profit. They have shareholders to whom they are accountable. And if their business model isn't profitable, they are not going to survive. That's why they are much more comfortable lending money to a rich guy than a poor guy. When you are a billionaire, for example, the bank can sleep peacefully because no one is worried that you might default on your loan. And if something happens, in case you can't make your monthly payments, you can easily sell part of your business to pay back your mortgage, which makes loaning money to you almost risk-free. In fact, that's how the banking system evolved over the centuries, where banks would only work with nobility, with people who had money or assets that constantly generate income such as land. Compare that to an average employee who could get sick or might not be able to work or just lose his job. If you are barely making ends meet, loaning money to you is extremely risky. I know that it's easy to criticize banks for that, but think about it. Would you feel comfortable loaning money to a friend who barely makes any money or a friend who has a business? Probably the latter, no matter how harsh it sounds. So if you want to get a lower mortgage rate, a lower credit card rate, just better terms when borrowing money, you have to do better financially first. Banks also offer such a low mortgage rate to establish strong relationships with rich people so that when they would need a bigger loan, they will come to them. It's a win-win situation. Technologies such as blockchain or cryptocurrencies are promising to change that and democratize banking, and they will probably to a certain extent. In fact, banking has been democratized to the point where everyone has access to financial services. Compare that to 100 years ago. 5. Credit cards are banks' nuclear weapons. 70% of Americans with credit card debt admit they can't pay it off this year. Think for a moment about what that means. Your credit card debt isn't like your mortgage. It isn't like 3.5% a year. It's probably like 20%. If you can't pay your credit card debt on time now, what makes you think that you can pay it a few months later when that debt has grown much bigger? In other words, 70% of Americans are about to fall into the debt trap. Over half of those surveyed, 56%, say they've had credit card debt for at least a year, and most will continue to carry it for years to come. Almost 20% estimate it will take them more than 3 years to pay off their debt, while roughly 8% say they don't know when they'll be able to pay it down. And that's how banks usually make fortunes, because most people spend without thinking about how they will pay it back. They are used to a certain standard of living, and they are ready to keep it even if they can't afford it. That's why banks keep calling you to sell you a brand new credit card. Don't get me wrong, using credit cards responsibly is great to build your credit score, but if you are not financially responsible, then you shouldn't get yourself into that debt trap. That's it for today's episode. If you have enjoyed this video, give this video the thumbs up that it deserves, and make sure to subscribe if you haven't done that yet. Don't forget to share this information with your loved ones and friends. Let's all get financially savvy together. Thanks for watching and see you again soon.